going to get started. I just wanted to quickly thank everyone for coming today. This is a topic that's of significant interest to me personally and to the Capital Forum, and we're really excited to have a great slate of speakers and delve into what's going on in this industry and how policymakers and industry stakeholders should be thinking about what's going on in the auto finance market right now. And I wanted to, I'm Teddy Downey, I'm the executive editor at the Capital Forum, and I wanted to just really quickly kick things off by talking about what has changed in this market a little bit. And you hear this concept a lot of financial innovation, and a lot of times people talk about financial innovation as something that's happened, that's developed, that's good, that's technological advance. It certainly can be very good for the businesses that are involved. But I want to think about, and leave some pictures and some thoughts for you of what does financial innovation mean for the borrower. Let's think about this from this perspective of the borrower, and how is financial innovation affecting the borrower. And so what is financial innovation in the subprime auto market, a financing market in the last several years since the financial collapse? And I think the first point, and if you have the data book, I'm not sure if we have the data books. If you don't have a data sheet, we have some at the front. But the lengthening of loan terms is probably one of the biggest innovations that's occurred in the past few years. And the OCC last year in their semi-annual risk perspective flagged this as a concern. And previously, really, you didn't see that. You didn't see loans that were longer than 60 months, and even then, that wasn't really the norm. And in the OCC report in fourth quarter of 2013, fourth quarter of 2014, it shows that the percentage of total auto loan originations with terms of more than 72 months, it's looking at close to 60% across the board from all lenders. So that, and just thinking about that, at first it seems, oh, I've got a longer loan term, I have a more affordable monthly payment. But as we go on today, I just want people to think about what does it really mean, especially as we get into some of these other financial innovations. But also, I think probably most importantly, just to take a step back and think about the amount of time that you're going to repay something is in itself a bit of a way to gauge affordability. So if you can afford something by paying for it over a shorter number of years, it's a more affordable product. And so you're lessening the affordability and the transparency into whether or not someone can repay by lengthening the loan terms. And we'll get to in a second, but further, you really have to think, are they really going to be holding on to this car for 72 months? Is that even feasible? Is it even plausible that these used cars could even last that long? So the second innovation is basically that lenders are selling less for more to subprime borrowers. And if you take a look at, again, in the OCC semi-annual risk perspective, the average used car LTV by credit score range, we're looking at 150% for credit scores under 620. This intellectually is unusual, because you would think that you're going to be able to, sell cars to rich people at higher LTVs because they're paying more for brand, they're paying more for things they don't need. Here you have the reverse. I mean, the 760 plus FICO scores are paying 100, 110% LTV. What's going on where these lenders have gotten incredibly efficient at getting subprime borrowers to get less for more money? And if you go to page 5 here, there's a Manheim Consulting report on what $5,000 will buy you, right? $5,000 now will buy you a car with 120,000 miles on it, right? Whereas a few years ago, you're getting a car with 80,000 miles on it. So your subprime borrowers are paying more for less. And going back to that first question, are they really going to be able to hold on to this? Is this car really going to last for 72 months if it's got 120,000 miles on it? And in addition to that, I think the borrower is also going to be paying a lot more in repair fees because it's an older car. So there's another additional wrinkle on how much it's costing the subprime borrower to buy these cars. And lastly, repossessing the car. I think we have a page here that shows how much repossessions are going up, which I think, page 9 here. I think a lot of people think of financial innovation. It's gotten a lot easier to repossess the car. And so that's good because the lender isn't going to have to lose as much money. They can take back the car and sell it. And this works as long as used car prices are going up and as long as financing remains robust. And so I want to just kind of leave it in your minds that these financial innovations and how they're actually working their way through and affecting the borrower, and what that really ends up meaning. And in terms of the number of repossessions, right? If you think about for a moment what happens if the financing dries up, or if used car values go down, do all of these things that we've thought of as innovations end up really becoming more of a problem? And for example, in terms of repossessions, as the price of the used car goes down, the lender is going to have much more incentive to try to repossess the car because they want to sell it before the price goes down more. So you're already seeing an acceleration in repossessions, even though defaults haven't gone up that much. But if used car prices go down, how aggressive will the repossessions become, and how much will they enhance, and how much will defaults go up, and how many subprime borrowers will be left with cars that don't have much of a lifespan if they can't go out and turn that car in and get a new car because the credit's dried up. So I know that's probably a lot to throw at you in the first few minutes here, but those are some of the thoughts and some of the questions I'd like people to keep in mind as we go through the day of what's going on with these borrowers and how these policies